Financial markets tend to be a little bit on the obsessive side recently. It was tapering, then the debt ceiling. Now the big question is, will earnings derail the bull market? In last week's video, we said the markets were very uncertain and we needed to focus on price and observable evidence that served us well. In this week's video, with earnings season stepping up as the next potential obsession in the markets, we'll look at daily, weekly, and monthly charts, and we'll begin with the weekly, comparing the peaking process in 2007 and 2008 to 2013. The rationale being, if earnings season is to derail the bull market, we would expect to see some similarities to this peaking process in the present day. We'll make head-to-head comparisons. We'll discuss how we manage intra-week changes to charts and head fakes, updates on the CCM market model, and other charts that you can find on the web. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. This is a weekly chart of the S&P 500 index, a chart used in the CCM market model to monitor trends. We're looking at 2007 and 2008. We will compare it to the present day. The rationale, if you study markets, you know that markets have a tendency to send up warning flares prior to things like 50% declines that occurred from this point here. 2007, 2008. Let's look at some of the warning flares. Flare number one, bearish moving average crossover. Pretty good signal. It occurred when the S&P 500 was trading at 1520. There's one of your first warning flares that came up. Get the bearish moving average crossover. Notice we never get a sustainable bullish cross. This says stay out of stocks, reduce risk, etc. Number two, the weekly chart starts to make a series of lower highs instead of higher highs. It's a lower high on a closing basis, lower high on a closing basis. Flare number three, a weekly trend line was broken here and again here. And here it occurred in a decisive manner simultaneously with a bearish moving average crossover where blue goes below red. A bullish look is price above both moving averages, blue above red, the slopes of both up, and price rising as well. A bearish look is the mirror image, blue below red, slopes of both down, price below. Another warning flare that came in the form of observable evidence is this orange box. You have a stock market that's consolidating, waving yellow flags, and at this point here, the stock market has made no progress in 10 months. And what this tells us is the battle between bullish economic conviction and bearish economic conviction is roughly even in here, and this is where it's shifting from a bullish bias to a bearish bias. We make a new 10-month low here, yellow flag, and then the pink box shows us, again, prior to an additional 50% decline. Yet another warning. For 6 months, the stock market was making a series of lower lows and lower highs. This is a downtrend here. It's a lower low. It's a lower low. A lower low. Lower high on a weekly closing basis. Lower high. Lower high. All observable. Everything on this chart was observable, and it all occurred prior to an additional 50% decline. The S&P 500 is at 1320 here. It eventually goes to the exorcist low of 666 in March of 2009. Let's compare the warning flares and peaking process from 2007 and 2008 to the present day, with the rationale being if earning season or the political process in Washington are to derail the bull market, we would expect to see warning flares. Here's the same weekly chart used in the CCM market model. Now we've fast forwarded to 2012 here and 2013 here. Let's compare 2007 and 2008 to the present day and see if we have any of these warning flares. Warning flare number 1 was a bearish moving average crossover. The present day, as of the close, and that's a key word, we do not have a bearish moving average crossover. We have price above blue, price above red, blue above red, and the slopes of both turned back up late in the week. This looks nothing like this. Warning flare number 2 was a series of lower highs that started to develop on the weekly chart of the S&P 500 and a series of lower lows. Do we have that now? Not yet. This high exceeds this high, if you look closely. This high exceeds this high. Do we have a series of lower lows on the weekly chart? No, we do not. There's not a meaningful lower low on this chart relative to this uptrend here. How has the stock market done in the last 10 months? Remember, this yellow box told us the stock market made no progress during this 10-month period here highlighted by the yellow box. Here, this is a 10-month period. In the present day, this looks nothing like this. If the present day looked like this peaking process, this is where the S&P 500 would be now, all the way down somewhere in the neighborhood of 18, 14, 20-ish. Instead, we're at 1700. We also had a series of lower lows and lower highs for a 6-month period prior to this 50% decline point here. We drop an additional 50%. The pink box is 6 months. The last 6 months, have we been making a series of lower lows and lower highs? The answer is no. The takeaway is the present day market is not tipping its hand that it believes that earnings and or a U.S. default would derail the bull market. If the present day chart starts to morph into something more like this period here, the market model will have us step away. This is the same weekly chart that we just looked at. We've got EMA 3, EMA 5 on a weekly basis. This is 2013, and this is as of the close on Tuesday this week. We'll cover 2 tenets that we often discuss in these videos. The market model was designed to minimize the probability of making common mistakes, which speaks to experience. Tuesday of this week, this has an ugly, bearish look. Price below both moving averages, blue below red. The slopes of both moving averages turning down. Why do we say that Friday closes are the most important thing on a weekly chart? Well, if you think about it, when we look at weekly charts historically, study them and build models based on weekly charts, they only show us the market's profile as of the close on Friday. So when I look at this chart, I have no idea what happened intra-week here. And if your model is based on historical data that only gives you the market's profile on a Friday, you can get head fakes between Monday and Thursday. Tuesday of this week, the profile didn't look good. We also broke an upward sloping trend line. How do we handle that in the market model? Because a lot of bad things can happen between Monday and Thursday. The way you handle it is you take incremental steps to align with this profile on a Tuesday. So for example, hypothetically, if the market model between the previous Friday's close and this Tuesday said that this deterioration called for a 20% reduction in our exposure to risk, on a Tuesday, you wouldn't take the full move. You would take an incremental step. So instead of doing 20% on a Tuesday, you might do 6%. You might do 10%. The rationale is I'm cutting risk if this market plunges between a Tuesday and a Friday. But I'm also acknowledging on a Tuesday that I could be wrong. So if I take an incremental step away, it lowers the probability of making a big mistake. So now let's look at the same chart as of Friday's close. One of the problems that we have, all of us as human beings, is we let our biases creep into our decisions. We also have what's known as recency bias. On Tuesday, this chart does not look good. We have a tendency to extrapolate that in this direction. And there's nothing wrong with that. You just need to understand that at any point, a chart can repair itself and markets can reverse. This is the same chart as of Friday's close. It looks radically different and much improved on Friday relative to Tuesday. The second tenet that we often preach in these videos based upon experience and mistakes made in the past, mistakes that we do not want to repeat in the future, is to be flexible and open-minded and to throw your biases or push your biases to the side. If I'm biased here and I'm not flexible and I'm not open-minded, from a mental perspective, I will not be prepared at all for what took place between Tuesday and Friday. I assume, if I'm closed-minded and biased, that Wednesday, Thursday, and Friday will continue this ugly look and we're going in this direction. If I keep an open mind and I'm flexible, I already have a buy list ready or a method to produce a buy list quickly, knowing that markets can reverse at any time. A flexible and open mind allowed the model and the operator of the model to scale back in between this look and this look. Flexible and open-minded Friday closes are important. Tuesday closes are meaningful, but not nearly as meaningful as Friday. The change that took place on this chart is just one example of the incredible weekly repair that took place on numerous charts used in the market model between Tuesday's close and Friday's close. Observable changes took place between Tuesday's close and Friday's close, allowing the market model to record them and telling us to scale back into the long side of the market. Why are you cutting risk here? You're cutting risk here because this is a negative profile that can morph into something significantly worse than what we have here. Here the odds tend to be in our favor. Price above blue, blue above red, slopes up, price above, slope going up. This is a favorable look. This is an unfavorable look. The way the model works, as long as the unfavorable look remains in force, you reduce risk and you wait for proof that it's time to get back in. Where's the observable proof? This chart is bullish. Observable evidence between here and here. To show you how we track the observable changes in the market's profile, as well as to give you an idea of how much improvement we saw between Tuesday's close and Friday's close, we're going to look at the correlation model, which is one of the 5 submodels that feed into the master market model. This is the master spreadsheet for one of the submodels, the CCM correlation model. These are the ratios and charts that the model tracks. The higher you are on this list, the higher the weighting due to a higher correlation to price. So if you want to know where the S&P 500 is going, it's logical that the market itself has the best correlation. It has a correlation of 1. As we move down here and move further away from price, these become less meaningful. How do we track all of this stuff? Here's another important point. No bias. Binary yes or no questions. Observable evidence. Tracks all of this information. No way bias can creep in when you're looking at zeros and ones. We also look at thresholds. The model uses thresholds. I'm crossing bullish thresholds. I'm crossing bearish thresholds. And then it does a ton of calculations here. There's no possible way that a human being between Tuesday's close and Friday's close can wrap their arms around all of this and process it fast enough, especially if you're biased. If you have an open mind and you have a good system, you can do it, absolutely. For our time frames and for what we do, this allows us to keep track of it all. How much improvement did we see between the close on Tuesday, October 8th, and the close on Friday, the 11th? Tuesday, the 8th, the correlation model scored an 18 on a scale of 0 to 100. That's awful. This is a high-risk market here, and why we reduce risk when we see a score like this. The probability of bad things happening is high here. We had significant improvement between the close on Tuesday and the close on Friday. This model moved from an 18 to a 57. What this really tells us here is 18% of the binary yes or no questions and or 18% of the hurdles that the model tries to cover and cross came back with a bullish answer here, telling us that 72% of the answers were bearish on Tuesday. As of the close on Friday, we had flipped from a bearish bias in this model back to a bullish bias. Now 57% of the questions are being answered in a bullish manner or have crossed bullish thresholds, and only 43% were bearish. I think it's safe to make the assumption there are a lot of traders that may have no interest in following the market model or Shavako Capital on Twitter. Why? Well, if you're trading 60-minute charts or 1-minute charts, you may feel that a monthly chart, a daily chart, or a weekly chart really doesn't impact you. But that's not true. The most bullish circumstances are when a 1-minute, 10-minute, 15-minute, 30-minute, 60-minute, daily, weekly, and monthly all align in a bullish manner. Conversely, the most bearish conditions are when our 1-minute all the way out to our monthly chart align in a bearish manner. Time frames matter relative to how confident you should be. So if I'm trading 60-minute charts here in 2001 with a bearish monthly profile and a bearish weekly profile and a bearish daily profile, on that 60-minute chart, how would I use that? I should be much more apt to book profits early and cut losses quickly. Conversely, here, if I'm trading 60-minute charts and I have bullish daily, weekly, and monthly charts, just the opposite should happen. I should err on the side of trying to let my winners ride, and I may even give my losers a little bit more room in terms of holding them in the hope that the trend will right itself. All time frames matter, so even for us, it applies to us as well. Weekly is our best time frame for our clients and our objectives. However, that 1-minute, 10-minute, 15-minute, 30-minute, 60-minute chart still can help us with entries and exits and how confident we are relative to making a trade, or it might even help us size the trade between a Monday and a Thursday. Monthly chart, we're looking at the current profile relative to a bad things happen when profile. The concepts are all the same here, it's just a different time frame. Good things tend to happen in the stock market when price is above blue, when price is above red. Blue, bullish moving average crossover here, is above red and the slopes of both are up. Good things tend to happen. Bad things tend to happen on the mirror image. Bearish moving average crossover, blue drops below red, price below both, slopes down, bad things happen. Look how early in this process, even on a monthly chart, this signal came. This signal came before New Year's Day in 2008 and helped you avoid all of this. And also notice, you never get a bullish moving average crossover during this entire decline here. Point of the exercise today, what we're concerned about, do we think earnings and or the threat of a U.S. debt default or an actual default could make the market morph into something like this? Well, you can see consolidation here, and eventually we get the bearish cross, eventually we get the bearish cross. Here we really don't have any of that. We're making a new high here on a monthly chart. The slope of blue is up, the slope of red is up, price is above both. That's a bullish profile that looks a lot more like this period here than it does this period here. Another takeaway, notice how far away these moving averages are, blue and red. It's a double-edged sword. It does tell us we have some risk of that gap closing. But the other things it tells us is it's highly unlikely that we move immediately from something like this to something like this or this. Why? Well, you'll see here, you usually get some consolidation and a period where the trends start to roll over, and this big white space between the blue and the red starts to contract. You can see closer here, very close here, and finally you get the cross. Closer here, comes down, you get the cross. This takes time to get from here to here. It takes time to get from here to here. As the trend slows down, momentum slows and you roll over. Trend slows down, you roll over. It's not what we have here. And what that tells us is probably the worst case scenario now is consolidation and sideways movement and then maybe a fall. Consolidation, sideways movement, then a fall. Remember, this is a monthly chart. So this point right here is early in 2007, several months before the stock market falls. We can take the same concepts down to a daily chart. Now we have an EMA 13 and EMA 20. This is used in the ETF screening process. These are custom built moving averages for SPY. We have custom built moving averages for over 130 ETFs. Why custom built? The volatility characteristics of SPY are radically different than the volatility characteristics of bonds or an IEF or an AGG or an SHY. SPY is less volatile than something like SLV silver. What the moving averages help us do is discern between volatility to ignore. Leave this alone, it's a bullish profile, and volatility to respect. This is no longer a bullish profile. No action needed, no action needed, no action needed, no action needed. Have to start taking some action, defensive action in this box here. 2007 daily chart. Very early in the process, October of 2007, stock market peaks here. Within a couple of weeks, 3 weeks, we get a bearish moving average crossover here. So by November 1st, you've got a warning flare that's being shot up inside the CCM market model. If earnings or a debt default were to derail this market, we would expect the market to morph into something like this over time. October, November 2007 really looks nothing like the present day right now. However, you can make a case that this point right here is similar to this point right here, which tells us to keep an open mind. It is possible that something negative comes out of Washington or earnings are just absolutely horrible. And if that's the case, that's okay. We don't need to anticipate that. We will start to see deterioration, and it will show up on the daily, the weekly, and the monthly charts that we follow. We'll have time to react if we keep an open mind. This chart right now looks bullish, trying to turn. Nothing says it can't look like this in a few weeks. If it does, then we'll migrate to more of a bearish stance. A closed mind here without flexibility could have been painful. The same may apply here. We have to keep an open mind and we have to remain flexible. If you're a client, I think we proved that flexibility this week. We were able to migrate very, very quickly between the close on Tuesday and the close on Friday. Our allocation as of the close on Friday is in line with the market's current profile. If it continues to improve, we'll continue to scale in. If it morphs into something like this rather than scaling in, we'll start to scale out again to manage risk. Now we're looking at the master spreadsheet for the master CCM market model. Here, as of Wednesday's close on October 8th, it recommended a 60% exposure to conservative assets and a 40% exposure to risk assets. This is telling you we have a bearish profile here. Roughly 60% of the questions are being answered with bearish and only 40% are bullish. Significant observable improvement between the close here and here allowed the model and allowed us to scale from 40-ish to roughly 70%, 68, 67, 69% as of the close on Friday. These are the 5 sub-models that we talked about. Each one of these independently produces an allocation. The final allocation in the model is a weighted average based upon the predictive validity and value of each model. We have model redundancy. These models look at the markets in different ways, and they do different things on different time frames, meaning we have a master model that can deal with numerous circumstances or various conditions in the global financial markets. If you'd like to see more evidence about the market's current profile heading into earnings season, this article, 7 Reasons Why Thursday's Rally Was Not a Surprise, has several charts. If you Google 7 Reasons Why Thursday's Rally Was Not a Surprise and add short takes on the end, you can get to the clean version on our blog. You won't have to log in or do anything. There's no ads there. And you can scroll through and see charts, and there's lots of links to other posts with numerous charts. They all align with the theme of today's video, that the current profile of the market, which is always subject to change, does not seem to be waving yellow flags about a horrible earnings season. But obviously, as the earnings come out, a lot can change, and we'll keep a flexible and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.